Well, good morning. Today is January 25th, 2023, and Matt and I are going to go over this weekly brief that was titled U.S. Soft Landing and talking about some of the updates that have happened so far this year. One thing I wanted to diverse just a little bit is that the market is doing well for January, Matt. We've had 3 good weeks, a few bad days last week. For the most part, investors seem to be moderately positive about this year, so that's a good sign. But today's topic at hand is a soft landing, which is actually a good point. That is the conversation we're having, because we're not having the conversation of, is this economy going to sink into a deep recession? Do we have landmines in the economy? Are there some real issues with supply chains? Are company profits dropping? We're not having that conversation. In fact, we're having the conversation of how slow will the economy get before the Fed stop raising rates and then start seeing the companies start reviving the investors back to the marketplace. So that's a good conversation about a soft landing. And specifically what soft landing is sort of a term that investors use, that when the Feds or some circumstances taking place, it's reversing an uptrend and we're going into a downtrend. At one point, is it a complete collapse and catastrophe, or is it a kind of a rounded bottom that starts to level off without a lot of casualties and then start building up from there? And so what we listed in this weekly update is that the last 7 Federal Open Market Committee meetings, the Jerome Powell and the committee, as they said they would do, raised the discount rate 7 times. They started out at a 0.25 to 0.50% and have targeted 5%. That was their goal. And it's currently at 4.25 to 4.5. Most likely, next 2 rate hikes will be 0.25 or 0.25% each. That would be 0.5%, and that would hit their target at 5%. So now here we are, 7 rate hikes later, and economy seems to be doing okay. What are your thoughts, Matt? Are you seeing any landmines around, or are you kind of getting the same sense that economy is doing okay?
Yeah, I think your hypothesis of a soft landing is correct. I think Jerome Powell's really been working on getting us that soft landing and been working on fighting inflation, bringing it down. But at the same time, I think his goal really is to stabilize us, and we know that's his goal. And yeah, it hurt, but it's something that we needed to kind of stop the rocket ship that was unsustainable.
Right.
So with holiday sales being a little flat, car sales we're still doing good, but they're slowing a little bit. Housing market obviously slowing. I think that we are coming down a little bit, of course, but again, I think we're coming to a soft landing, and I think that mid-year, maybe late next year, I think we'll be doing good.
Yeah. So talk a little bit about the Bureau of Census on retail sales. We looked at that report. Talk a little bit about that, what has taken place and what they reported last week.
Yeah, so it looked like retail and food services were down about 1.1% in December. They were 1% down in November, 1.1 in October. So kind of a steady decline. Gas was down 4.6%
What a
in
relief
December
that is, right?
from November.
Yeah.
And then, but again, gas is going to be a little lower in December, November anyways. However, that's quite significant. And then, it's just sales in general, excluding gas for motor vehicles, was down 0.7%. So again, more of just a steady decline if you excluded those two.
Which plays into that soft landing scenario.
Yeah.
Because we're not down 2% or 5%.
Right, exactly.
And also keeping in mind, that's right through holiday sales, when normally you would have a rise in retail sales, if nothing else, short term. And yet that wasn't the case.
Right, exactly.
Yeah. And so that's a big deal. So consumers, which are 2/3 of our economy, have not been either eating up their credit cards or using up savings, they've been modest with
Right.
their spending. And one of the biggest areas that consumers spend is on their home. So we talk about home prices have contracted for the last 5 months, and home transactions have declined to a level that's below 2008. In fact, there's only 2 times in the last 20 years have actually going back to 1995, only twice have existing home transactions below 4 million or right at 4 million have been at that lowest pace. And the one was 2008, when we have a nationwide housing collapse, historic. And then the time before that was the pandemic, or the time after that, the pandemic. So 2 significant economic events that were equal to the number of homes that have transacted in the last month. So housing has come to a complete stop, at least for now. And the reason that's important is that consumer spending, probably the one largest expenditure, is going to be on their home. Carpet, front yard, light fixtures, painting, remodeling is going to be on their home. And so if home transactions are slowing down, then consumers are not going to be pretty much out there remodeling their home and getting it ready to sell. However, I think the transition is going to take place, which is maybe why Home Depot, the stock is down year to date when the market's up, is that there's this transition of people looking at their home. Well, we're going to stay here, so let's start saving our money and get ready to do the remodeling that we've always wanted to do.
Right.
And it's not right away. And and that's good discipline. What we're seeing is consumers are not going deep into debt. They're not pulling out the credit cards. And so consumer spending is slowing down, house transactions. And I think it's going to be years that housing will be modest in transactions, not because of the prospect of making more money. I think for the first time in 40 years, people are going to be evaluating, do they want to give up their mortgage?
Right.
People have most people in history have locked in fixed rate mortgages at 3.5%, 4%.
Yeah, it's a lot of golden eggs out there. Yeah.
Yeah. And right now, what are mortgages about?
6.4 about right now.
Right. That's a big deal.
Yeah.
Even if you did a straight across same cost of a home.
Right.
And it doesn't matter if you go from California to Missouri, it's still 6.4%. You can't get away from this.
That's right. Yeah, and house prices have not fallen, in relation to interest rates yet.
Right.
They've fallen a little bit, sure, but not in the same amount that mortgage interest rates have risen.
Right.
So until that balances out, I think you're right. We're going to have a lot of people staying put because they got in at lower prices with extremely low rates.
Right. Right. So this brings us to our conclusion. What does this mean to me? A lot of our readers like to just jump right to the back part of our weekly briefs. So our view is that we are slowing down, which is exactly what the Feds said that they want to see. So yes, we are slowing down, but we're not collapsing. So that's good news. Consumer spending is modest and slowing down. So that's good news. And we are reading about fairly big layoffs. Meta announcing their layoffs. And we've seen other tech companies, Google, et cetera, announcing
Microsoft.
layoffs. But that doesn't seem to be, not affecting the unemployment. And that's primarily because of reports I'm reading, Matt, about how quickly these people are being able to reestablish new jobs. So there's a big market. So that's good news. So we haven't seen any bump in the unemployment despite fairly big number announcement layoffs. Of course, they don't happen when they announce it. It's usually over a year's time, but nonetheless, they seem to be, reports are indicating that they assimilate very quickly into other industries or other businesses. So that's good. Consumer spending, as we mentioned, is 2/3 of our economy. Households seem to be in good shape. So that's good. So our view is that the market's having a good January. 83% of historical consistency of when the Dow has a good first 5 trading days of the year, 83% of the time that year is a positive year. So for whatever that is, that's That's a little nugget of information that's worth looking at. On a technical component, the 20-day, 50-day, and 200-day moving averages of the S&P 500 are now below. So what that means is, like, if you were a batter and you're in a slump, and what the coaches want to see is to see your batting average start to improve. And it doesn't improve with one good hit. It improves with multiple at-bats of more base on balls than not, strikeouts, pop-outs, etc. And it doesn't happen in one game, 3 at-bats. It takes many games and sometimes many weeks, and where the batting average starts to improve. But what's that indicating is that this player is getting it together. He's starting to pull it together. And that's true for the stock index on a technical component. The S&P doesn't start to improve in one day, but in 20 days, which is a 20-day moving average of 20 days, it's now outperforming. Then that's good. It's been doing better, more good than bad in 20 days. 50 days, almost 2 months, that's good. And 200 days is more than half a year. And now the S&P 500 is above all 3 of those. So that means it is moving up faster than its 20-day, 50-day, and 200-day moving average. So that's all very good news on a technical component. Not what we'd be really looking for is there's this higher highs and higher lows. So when it bumps up and then peaks and comes back, does it peak at its above its previous peak or below? So right now it's still below the peak that it reached in October, but for it to break above that would be a third confirming technical positive for the market. So fundamentally, the economy seems to be good. Households seem to be in good shape. Retail sales, the prospects of a soft landing, all of that's good. Technically, the market is performing better than the last 20, 50, and 200-day averages. So that's good. And NASDAQ has outperformed the S&P. And there's 2 good things about that. NASDAQ index was down 32% last year. S&P 500 was down 19%. So a good rebound of the worst performing index would also be positive. Investors are looking for good investment opportunities. So they're more risky with their portfolios. So that's good. The NASDAQ has not quite breached the 200-day moving average, but it has surpassed its 20-day and 50-day. So that's good. So your thoughts, Matt, on how you're seeing things coming together this year?
I think we're right there. We were talking yesterday, trying to figure out if we were at the bottom of the ramp, ready to launch out.
Right.
And that's a big decision that you have to make.
Right.
And from my outlook, I think you're right. I think people were being conservative. They're stuck in their homes with good interest rates. Cars are expensive, so they're choosing to keep their cars. They're saving a little bit more money because they know they're staying put. They know they're keeping their car. They need to save money for repairs. I think that we're getting ready for people to have a little bit more money than normal, and we're going to ramp up and we're going to have a good year.
Right. And as you mentioned earlier, gas sales, gas prices are down, so that helps out. Another big expenditure for consumers, so they have a little more savings to work with. And I joke with you all the time, Matt. I said, I'm positive most of the time, and that's because the odds are in our favor, because 2/3 of the time the stock market goes up.
Right.
So I'd rather be on the side of 2/3 of the time chance of being right than the 1/3. But there are those perennial bears. There are articles from Goldman Sachs and others saying there's another 20% of the downside, and I'm not really seeing that right yet. So there's a lot of reasons to feel better about this year. So we'll keep you posted on that. Well, that's today's update, and appreciate you all listening to this. Give us a call or send us an email, drop us a line if you have any questions. And with the email, in the email with our weekly brief are the charts that we refer to, or at our website at upcapitalmgmt.com, and you can see all these charts. So with that, we'll talk to you next week. Bye.